Hello everybody, it's great to see you back. We are happy to be back here for another month. In fact, believe it or not, we are filming this on the Saturday morning of a long weekend because that is just how committed we are to the grind. Well, at least some of us are. I've got my usual friend Ollie back behind the camera with me, but our other usual friend Emma is nowhere to be found. You know, Ollie, back when I was Emma's age, I used to have to walk uphill both ways in a storm to get to my plushy condo listing to film my silly little videos. So, you know, young people these days, what can you do? Anyway, March was a pretty eventful month in the exciting world of Ottawa real estate, right? Our freehold market was comme ci, comme ça, as my people like to say. The struggling condo market, on the other hand, which had shown signs of a bounce back in February, gave us a big old psych in March. Ollie, do people still say psych?
No.
Okay, Ollie says no, but what do you know, Ollie? You're not Emma. And finally, we're getting way off track here, but finally, in March, also in March, the Ontario government and the Canadian federal government came together to announce a couple of major new initiatives that they say are going to make new construction homes in Ontario far more affordable. But will they? Huh? Kind of feels like we've been down this road before, doesn't it? But hey, maybe this time will be different. In any case, we're going to tell you all about it and give you our thoughts and a whole lot more in your April 2026 Ottawa real estate market update. Ollie, say it with me. Let's go! Oh, Ollie didn't just say it there. He put the jazz hands in front of the camera. Anyone ever told you could be like a hand model, Ollie?
Nope.
I think you chose the wrong career, my friend. There's big money in that. So we are going to get to those big announcements that could potentially lead to significant rebates on new construction homes in Ontario in the second half of the video. But for now, we're going to tell you all about how Ottawa's freehold and condo markets fared last month, which of course would be March of 2026. And as always, we are going to kick things off with freehold. So without further ado, let's get those March 2026 freehold sales stats up on the screen. Ollie, give me a really emphatic sound on 3. 1, 2, 3.
Quack.
Are you trying to hurt me? We'll do better on the condo section. All right, get ready because it's coming again. And call on you again in this video, and I need a better turnout than that. All right, so in March, we sold a total of 692 freehold homes in Ottawa. That was up from the 505 we sold in February, the month that comes before March, which is very predictable, all right? In just about every single year, we'll see a pronounced jump in sales from February to March. It would be quite noteworthy if we didn't. Foreshadowing. So yeah, while our March sales total of 692 was better than the previous month, it did fall well short of last year's March total of 733 freehold sales. And I'll remind you that March of 2025 was not a great March, all right? It was certainly no March of the Penguins. Huh? You know, I thought of deleting that joke, and then hearing it come out of my mouth just now and look at the camera, made me realize that I made a mistake leaving it in. Ollie is shaking his head yes. All right, anyway, this year's March total didn't technically fall outside of our usual range for the month, but that's only because there really is no usual range for the month of March. Even if we eliminate the COVID years, which were obvious outliers, since 2015, we've had March totals that ranged between like just above 600 and well over 1,000, right? So like obviously weather plays a part in that. Right? In some years, March is very much a winter month, and in other years, it feels much more like the start of spring. That said, March also tends to be a very good predictor of the type of year we are about to have. Right? In hot years, a lot of buyers and sellers look to get an early jump on the market, and that's when we typically see a lot of sales happen in March. And then of course, in weaker years, we see the exact opposite effect. Buyers and sellers just feel no sense of urgency. So March does tend to often kind of set the tone for the rest of the year. And unfortunately for us poor realtors, this year's March total was literally among the weakest we've had. This was one of just 3 instances over the past 17 years where we failed to break 700 sales in March. That said, there is still a lot of year left to go. And our average sale price for the month of March paints a much more positive picture. The average sale price of a freehold home here in March was just a hair over $803,000. Now that's well up from February's average of $775K, and it's also up from last year's March average of about $794K. Now, our strongest ever March came in 2022, and that was a whopping $919,000 average sale price. That was literally the all-time high for any single month in Ottawa's history. So needless to say, we probably won't see that again anytime soon. But if we ignore that outlier month, this year's March average is actually literally just a few $100s shy of the next highest average, which came in March of 2024. Now, let's talk about our indicator stats, which of course are inventory, sales to new listings ratio, and the average number of days it takes for a home to sell. All right, we'll start with inventory. Ollie, this is the moment you've been waiting for. Tell the people what inventory is and how it works.
How it works? It's a stat measured in months that looks at the relationship between supply and demand.
Oh, give it up. Ollie nails it. I don't even have to read the next couple lines. Inventory, which is a stat that is expressed in months and measures the relationship between supply. That's literally what it says on the teleprompter. So inventory ticked down in March. All right, so we started March with 3.21 months of freehold inventory, and then we ended it with 3.08 months of inventory, right? So in practical terms, that means 2 things. First, it means that for the month of March, freehold demand outpaced freehold supply. And second, it means that based on the current pace of the market, it would take us 3.08 months to sell all of our current active listings, our current active freehold listings. So to put that into context for you, 3.08 months of inventory falls at the high end of the range we'd expect in a seller's market, right? So basically, it's indicating a weak seller's market. Right. Now, our sales to new listings ratio, on the other hand, came in at about 48% for the month of March, and that falls right around the midpoint of the balanced market range for that stat. And then finally, in March, properties that sold took on average 36 days to do so. That also falls within the balanced market range for that particular stat. As always, you have to take these indicator stats with a grain of salt. They're really just rules of thumb. That's a thumb, and they don't always paint the same picture. That's why we call them indicators and not determinators or whatever. All in all though, I'd say our freehold market right now is quite strong in the more central areas, especially when it comes to properties and priced in the lower brackets for those respective neighborhoods. Quick story, we literally launched one of those types of properties 48 hours ago. Within 24 hours, we had received 15 showings and 4 offers on the property, and we were priced right, you know? In the suburbs, right, and in areas just past the suburbs, things are definitely moving slower. And then the same applies for properties that are in the very top price brackets across the city, right? Cool? All right, that'll do it for the freehold stats. Now let's tackle condos, which had a pretty interesting month, before we dig into these new construction rebate programs. So Ollie, this is your time to shine. You dropped the ball for the freehold sound effect. All right, you did really well on the inventory thing though, so you're 1 for 2. But this is it. This is the moment. We are going to get those condo stats up on the screen, but before we do that, Ollie, your best sound effect. 1, 2, 3. It is so hard to find good help. There are the condo stats. Ollie's going to work on his sound effects and he's going to work on his hand stuff for next month. In the meantime, allow me to tell you that we sold 222 condos in Ottawa in March of this year. Now that is just barely better than the 218 we sold the previous month, AKA February. And like I said earlier in the video, we expect to see a significant increase in sales for both freehold and condo when we transition from February to March. Like, we're talking about a 20 to 40+% jump as being normal at this time of year. To see sales stagnate in the way they just did is quite jarring. And make no mistake, 222 sales is also a very weak mark. It's not like we had this red hot February and then you could explain it, right? So 222 sales, in fact, is literally the lowest March condo sales total we've had since 2016, and it's by a mile. The next lowest March came in 2023, which was also a very weak year, but our total that March was 289. That's almost 30% higher than this year's total. In fact, I feel bad just calling this year's total a total to begin with, because that's an insult to all the other totals that did their best. So March 2026, you're not a total, you don't deserve it, you're a sum, all right? You're just a sum of a bitch. This is what happens when you film these on a Saturday. All right, anyway, now that I got that off my chest, the average sale price for condos in March was a little under $414,000. Now, there's kind of good news and bad news in that total. The good news is that the average sale price did manage to stay within our typical range for condos, right? And for those who are new to these parts, that typical range extends from about $410,000 to about $455,000. The average sale price of condos here has lived within that range almost exclusively for nearly 4 years now, right? The bad news, of course, is that this month's total came very close to falling below that range's lower threshold, which is something that's literally only happened once in the past 51 months. So, not terrible, not great. And then when it comes to our indicator stats for condos in March, the hits just kept on coming. We saw inventory spike up from 3.74 months to 4.87 months, right? That of course means that condo supply greatly outpaced demand for the month, right? And now of course, it is just 1 month, but we would normally expect to see inventory come down from February to March, right? So to see it not just go up, but to spike up is quite unusual, to say the least. The tiny silver lining in all this, I guess, is that 4.87 months of inventory does technically still fall into that stat's balanced market range, right? You'd have to get into the 5s before you hit what we consider to be buyer market range. That said, our condo sales to new listings ratio for March fell to 35%, and that is in buyer market territory for that particular stat. And again, it's pretty uncommon to see that in the month of March. Right? This is usually a month where things move pretty well. And then finally, condos that sold in March, all 222 of them, on average took 46 days to do so. That's actually not bad at all. It's right around the midpoint of that stat's balanced market range. Right? So some kind of mixed messages there with the stats, but all in all, our condo market continues to really lag behind our freehold market right now, and that's especially pronounced in the apartment condo segment of the market, especially in and around the downtown core. Condo townhouses, most of which are in and around the suburbs, on the other hand, are faring a fair bit better, right, than the apartments. So apartments are in a full-on buyer's market right now. That said, the units that are in these sort of A to A+ buildings with great floor plans and views, those units are still moving pretty okay if they're priced right? But it's when you get into the stuff that's kind of like a B+ or worse, that's where it gets really challenging just to find buyers, much less sell the units. And then I'd say the condo townhouse market, on the other hand, for the most part, is either balanced or maybe like a weak buyer's market, depending on the pocket of the city you're talking about. So that'll do it for the stats this month, folks. I hope you had fun. Ollie, it was fun, yes?
Absolutely.
He's shaking his head like this and saying yes, so I don't know, he's sending me mixed messages. Well, in any case, if you thought that was fun, you ain't seen nothing yet. And if you didn't think it was very fun, well, we promise we're gonna do better in the second half of the video, all right? Speaking of fun, you know what hasn't been fun for a while now? Trying to buy a brand new home. And the reason for that is that they've just gotten so damn expensive. And when people aren't buying new homes, you know who else stops having fun? Builders, right? So nobody's having fun right now. Thankfully, Prime Minister of Canada, Mark Carney, and the Premier of Ontario, Doug Ford, they want to bring the fun back, all right? And they've pledged to spend billions of dollars together in order to do just that. And so in March of this year, Ontario partnered with the federal government and announced two major new initiatives that are aimed at significantly reducing the cost of a brand new home in the province. But for whom? So information is still coming out about each of these two initiatives. We don't have all the details yet, but we are going to tell you everything we know about them so far. And then, of course, we'll share our thoughts, the good, the bad, and the stupid. Let's get to it. The first big announcement was that the government will be waiving the entire 13% HST on the majority of new and pre-construction home purchases in Ontario. It is worth noting that this is actually a modification to a previous initiative from October 2025. That initiative also waived the HST on new and pre-construction homes, but only if you were a first-time home buyer and only if you were also purchasing the home as a primary resident, so you were going to live in it yourself. So what they've done now is that they have extended this full HST rebate so that it now applies to the vast majority of new home purchases. All right, so it no longer matters whether you're a first-time home buyer, and it also no longer matters whether you intend to use the home for yourself or as a rental property. All right, so all of those purchases now qualify, or most of those purchases now qualify. There's a few important notes about this initiative. So the first thing to note is this is not forever, okay? This is a temporary initiative, the full HST rebate, that will only apply to new and pre-construction agreements that are signed between April 1st of this year, 2026, and March 31st of next year, 2027. Second, the full 13% rebate will only be available for purchases up to $1 million. In other words, the maximum rebate will be $130,000. Third, the maximum rebate of $130K will still apply to purchases between $1 million and $1.85 million, right? So you kind of get most of your HST, $130,000 worth of it, rebated on those purchases, but not all of it. And then for purchases over $1.85 million, the old HST rebate program will still apply. For those who aren't familiar, that particular rebate maxes out at $24,000. The fourth thing to keep in mind about this HST rebate initiative is that properties purchased as investments will only qualify if they are rented to long-term residential tenants, right? So no Airbnbs, no shorter medium-term rentals, no leaving the property vacant, and no commercial tenants. It has to be rented out as a home to someone who's on a 12-month lease or longer. And finally, in order for a pre-construction purchase to qualify, the construction of that home has to start on or before December 31st, 2028, and the home has to be substantially completed by December 31st, 2031. All right, so that's what we know about the expanded new and pre-construction home HST rebate program. Now, the second major initiative that was announced in late March was aimed at reducing municipal development charges by 30 to 50% in Ontario municipalities where housing shortages are most acute. And the way we're going to do that is that the province and the federal government will be co-investing $8.8 billion over the next 10 years towards municipal infrastructure projects. In order to get a piece of those $8.8 billion in infrastructure funding, a municipality must commit to lowering its development charges by 30 to 50% for a period of at least 3 years. And if you're not familiar, municipal development charges are fees that cities like Ottawa, Toronto, etc. charge to builders in order for the city to provide the infrastructure needed to support new developments, right? So think roadways, public transit, water and sewer infrastructure, parks, community services, etc., right? Things of that nature. And in recent years, development charges have skyrocketed, right? Which of course has caused the cost of new construction to also skyrocket right along with it. Now, Ontario literally has some of the highest development charges in the entire country, right? We are talking tens of thousands, if not hundreds of thousands of dollars per unit in places like Ottawa and Toronto. right? And so in a best case scenario, those high development charges get passed down to the buyer, right? But in a worst case scenario, they kill projects entirely. So in a nutshell, by subsidizing municipal infrastructure projects, the feds and provincial government are looking to bring the cost of new development down, which would, in theory, make projects more viable and more affordable for buyers. Between the HST rebate and the proposed 30 to 50% reduction in development charges, it's believed that we'll be able to reduce the cost of building a new home in Ontario by up to $200,000. That may not be much to people like Ollie, but to most people, it is significant. Ollie, I noticed you're not wearing your gold Rolex today. Did you leave it in your Porsche? Or?
Yeah, in my Lambo.
Oh, it's in the Lambo, that's what, and you took the Porsche to come, that makes sense. All right, good to be Ollie. All right, those are the initiatives. Now, before we wrap, allow me to share a few thoughts, both positive and less positive about this whole thing. So the positive here is pretty obvious, right? Like if we can make it significantly less expensive to build homes, then it should, in theory, make it significantly less expensive to buy them. Right? Another positive to these initiatives is that they could make affordable housing projects much more financially viable, especially when it comes to purpose-built rentals. I think builders know that there is a ton of demand for what's classified as affordable rental housing, right? But they barely build any of it in spite of that because the economics for that type of project are very, very challenging. And so instead, they just keep building more luxury suites, even though that segment of the market in a lot of places, quite frankly, is becoming oversaturated, right? But those are still the only projects that really kind of paper. So by helping builders make the numbers work, we're hopefully also enabling them to deliver the kind of product that people actually want and need. And then speaking of the kind of product that people actually want, the other positive I could see coming from this is an increase in the build quality of new construction homes. I don't think it's going to be a shock to anyone, but in recent years, we've seen a sharp decline in everything from build quality to workmanship to finishes and functionality, pretty much across the board in new construction homes. And builders have done that out of necessity, right? It's not because they're like greedy or cheap or any of that. It's because they are literally desperately trying to do anything they can to keep prices in a range that is like somewhat affordable, but that's really been an uphill battle. So the financial relief that these incentives should provide builders will hopefully lead to the builder's ability to increase the overall quality of their products moving forward. Those are the main positives that I can see coming from these initiatives, but as you can imagine, I also have some critiques. So I'm gonna give you one critique that is specific to each program, and then I'll tell you about why I feel a teeny wee bit skeptical about this whole thing in general. With regards to the HST rebate, in very typical fashion, the provincial government came out and made this big splashy announcement, right? No more HST on new homes across the board. We're returning affordability back to the housing market. Yay us, blah, blah, blah. But then they didn't tell anyone how the program is actually supposed to work. The program applies on new home purchase agreements signed as of April 1st of this year. That is a few days ago, right? And literally no one has any idea how the any of this works yet, right? I've personally spoken to a couple of builders and asked how these rebates are supposed to be applied. I know a few colleagues around, not just Ottawa, but Ontario who've done the same. And every single time the builders say they have no clue. Like no one's told them anything. They found out about these initiatives at the same time the rest of us did. So like if you're gonna roll out this massive initiative, free advice here, you would think that a little bit of planning would go into it, right? Like you might consult with the people that are gonna be involved. You know, like I don't know, does that feel unreasonable? Right? So everyone's in limbo right now. Everyone has questions about this program, but no one seems to have any answers. So once again, it's another one of these things that feels a little half-baked to me, right? And oftentimes, like you get the sense that some of these politicians really barely think beyond the headline, right? Especially when it comes to housing policy. Of course, as we hopefully learn more, we will keep you updated, right? But that's kind of where things stand right now. All right, now let's talk about development charges for a moment. Are we really sure it's a good idea to essentially subsidize development charges for municipalities? Have we asked that question? The reason development charges have gotten so out of control in the first place, or at least a big part of the reason, to be fair, is that most large municipalities kind of suck at managing their money. especially when it comes to large infrastructure projects. And if you don't believe me, go take a drive on literally any public street in the city of Ottawa. Or better yet, take public transit or go walk around the downtown core and tell me how our social services are doing. And I could keep going, right? So most cities seem to treat development charges as though there's some kind of like infinite money glitch, right? They don't want to raise property taxes because then the boomers will get pissed off. But if you get it from the big rich developers, then no one really seems to care, right? Until you get to the point where you're not able to build any more homes in your city because no one can fucking afford it, right? The federal and provincial government stepping in here and pledging $8.8 billion of taxpayer money, by the way, to basically artificially lower development charges for 3 years very much feels like a Band-Aid solution to me. And I also think it could just end up making things worse in the long run. What I predict is that over the course of the next 3 years, which is how long a municipality has to cut its development charges in order to get its share of the $8.8 billion, right? So over the course of these next 3 years, I think we're gonna see municipalities reduce their development charges, but raise property taxes. And then after the 3 years are up, I think we'll see development charges just shoot right back up to where they are now, if not higher, right? So that is my unfortunate prediction. Now, admittedly, I don't know exactly how you would do what I'm about to suggest. I would have liked for them to have made getting a piece of those $8.8 billion in government funds somehow contingent on the municipalities putting together a long-term plan to improve their fiscal management, right? And to bring down development charges in a way that feels more sustainable. This is just kind of like a temporary discount. It's like a sale on development charges. It feels like that person that like maxes out their credit card and then gets mom and dad to just pay it off for them, right? And they always say, it won't happen again, I learned my lesson, but we all know it will, right? All right, home stretch here. The biggest criticism, I've given you individual criticisms, but the biggest criticism, or maybe the biggest concern would be a better word for this. The biggest concern that I have with this combined program, right, development charge reduction and HST rebate, is that I am very skeptical about how much of these massive rebates on new construction homes will actually find their way into buyers' pockets rather than developers' pockets. We know how development fees will work. The cities are going to cut them by 30 to 50% and essentially have that loss subsidized by the federal and provincial governments. But when you reduce development charges, all you're doing literally is reducing the developer's cost, right? Or increasing their margins, whichever you prefer. There's absolutely no obligation for the developer to then turn around and pass those savings on to buyers, right? And there's certainly no guarantee that they will. And then for the HST, we told you that we don't really know how it's going to work. But I strongly suspect that it'll be treated the same way it is now, right? And if I'm right, then we're gonna run into the same problem I just described with development charges, is that we're essentially just going to be increasing a developer's margin without any guarantee that any of those savings will then be passed down to the consumer. Because you see, contrary to popular belief, all of the HST that is owed on a new construction home is already included in that home's sticker price. And also contrary to popular belief, it's not the buyer who pays the HST on a purchase, it's the builder. The buyer doesn't cut one check to the builder and one check to the federal government, right, for the house and the HST. And builders don't price their homes at, say, $700,000 plus HST. So the builder sets whatever sticker price they want on a home, but they do so knowing that a portion of that will have to be paid to the government, right? So they just factor it in, they work it into their numbers. And then the buyer pays the sticker price, and then the builder sends or remits the appropriate portion of that to the government to fulfill the builder's obligation to pay HST on that home. Still following me? I'll give you a practical example here. Under the old rules, on a new home priced at $767K, the builder would have to send $67K to the government to account for the HST that was owed on that home. Now, if this HST rebate is applied the way I suspect it will be, the only thing that will change is that during this 1 year rebate window, when the builder sells that same $767K home, they just get to keep the whole thing, right? They don't owe the government anything. The government's gonna say, you owe us zero, right, for this 1 year. So again, just like with the reduction in development charges, I suspect this HST rebate is going to be applied in a way that reduces the builder's costs without any guarantee that those savings will be passed on to buyers. So if those $767,000 homes I just mentioned are selling very well, or were selling very well before the rebate, what incentive does the builder have to drop their price? And so really, in a nutshell, the biggest issue that I have with these initiatives is that they were packaged as buyer initiatives, when in reality, I think these are actually builder initiatives. And it's very telling to me that both initiatives are temporary, right? So to me, that says like we're not actually looking to make long-term structural changes to housing affordability here, but rather we're really looking to help developers get traction on stalled projects, because we're afraid that Ontario is headed towards a construction recession. The construction industry makes up a huge portion of Ontario's GDP. And if we fall into a full-blown construction recession, the short-term and long-term negative impacts of that could be huge. So to me, that's really what this is all about. Now, that said, I think we should absolutely be doing everything we can to avoid a construction recession, full stop. And I'm also the guy who's been beating the build more homes drum for a long time here, right? So if increasing builder profit margins ultimately helps us get a bunch of stalled projects off the ground and leads to the building of more homes, then I think it's a net positive. And also, I do absolutely believe that builders will pass at least some of these savings on to buyers. I think they're gonna have no choice, right? The reason these things aren't selling is because they're too expensive. But how much of those savings will flow from the builder's pocket into the buyers is something we're just gonna have to wait to find out. That said, call me skeptical, but if you think these announcements means you're about to get like a smoking deal on a brand new home, I'd say maybe just temper your expectations a little bit. And then of course, if you're the kind of person who doesn't want to temper your expectations even a little, then you should give us a call. We've got a great team of skilled, no-nonsense agents who serve Ottawa buyers, sellers, and investors. And most importantly, we love what we do. So if you're thinking of making a move, or if you have any questions at all about the real estate market in Ottawa, please feel free to reach out to me at any time. My contact information is right here below. And you can also use the Calendly link in this video's description to access my calendar and book a discovery call with me at a time that works for you. That'll do it for this month, folks. As always, thank you for watching. I'm Serge Papineau from the Papineau Group in Ottawa. I appreciate you, and I'll see you next month.